Hello, 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 hello. Good morning to you all. Welcome to the day 4 of the Defining Factor series, which is organized by Mastercard Foundation in partnership with J Venture Capital, Pixera, MDF, Global Mamas, and Scale Up Africa. Over the past few days, my colleagues have gone ahead to talk about financial management, business developing tools for MSMEs, corporate governance, compliance. Today, our main focus of discussion will be accounts, tax, and audit. Two things they say is certain: tax and then debt. Today, I'm going to walk you through accounts, tax, and audit. When you look at Section 27 of the Income Tax Act 2016, so when you look at Section 27 of the Revenue Administration Act 2016, Act 915, it talks about the need to maintain proper books of accounts, proper records, and then you look at what Section 127 of the Companies Act 2019, Act 992. That also talks about maintaining documents and accounts. This should tell you that accounting and records are very key for every organization. Accountants are the heart of every business because they control a lot of everything. Begins and rests with the accountants. Let me walk you through the channel. Let me walk you through the channel. So we have accounting, audit, and tax. So accounting is just about preparing records, summarizing and classifying your transactions for a particular period. That is accounting. Audit is getting someone or looking over the accounts that have been prepared to give an independent opinion. And then tax is looking at what the audited accounts and at the audited report to look at what the tax exposure. That is what these three, that is the basic flow for accounts, audit, and tax. That is what it is. But I'll talk in details about accounts, audit, and tax in this slide. So what is accounting? Accounting is the process of recording financial transactions pertaining to a business. The accounting process includes collation, summarizing, analyzing, and reporting these transactions to shareholders, directors, oversight agencies, regulators, and tax collecting agencies. The financial statements used in accounting are a concise summary of financial transactions over an accounting period, summarizing a company's operations, financial position, and cash flow. Next slide. So, I want to say, regardless of the size of a business, accounting is a necessary function for decision making, cost planning, and measurement of economic performance. A bookkeeper can handle basic accounting needs, but a chartered accountant should be utilized for larger or more advanced accounting tasks. Two important types of accounting for businesses are managerial accounting and cost accounting. Managerial accounting helps management teams make business decisions, while cost accounting helps business owners decide how much of a product should cost, each production, unit economics, and cash management to optimize growth. Professional accountants follow a set of standards known as the generally accepted accounting principles when preparing financial statements. So, how does accounting work? So, accounting is very key, so we need to understand how it works. So, accounting is one of the key functions of almost any business. It may be handled by a bookkeeper, or an accountant at a small firm, or by sizable finance departments with dozens of employees at larger companies. The reports generated by various streams of accounting, such as cost accounting and managerial accounting, are invaluable in helping management make informed decisions. The financial statements that summarize a large company's operations, financial position, and cash flow over a particular period are concise and consolidated reports based on thousands of individual financial transactions. As a result, all accounting designations are the accumulation of years of studies and rigorous examinations, combined with a minimum number of years of practical experience. Be decisive about who you hire as an accountant. It can make a business. This statement, I mean, most people sometimes looking at the cost, they go in for a bookkeeper. But sometimes you need to get an accountant who can help you, like we said, handle your books properly. Because bookkeepers mostly just record the transactions, but an accountant will not only record, he will analyze it and classify them in such a way that will what? Reduce your tax exposure. That will help minimize your tax exposure. So is important that when businesses are hiring an accountant, they are very careful and very decisive about who to hire. They should not only focus on cost, but they should look at what the experience and exposure of the person. Because you say what it can make or make you as what a business owner. Thank you. So I'm coming to we have different types of accounting. We have, like I said, we have financial accounting, we have management accounting, and then we have cost accounting. Financial accounting refers to the process used to generate interim and annual financial statements. The results of all financial transactions that occur during an accounting period are summarized into the statement of financial position, statement of profit or loss, and cash flow statement. The financial statement of most companies are audited annually by an external audit firm. For companies in Ghana, audits are a legal requirement. Even when you look at the tax law, Section 28 of the Revenue Administrative Act 915, it talks about tax returns. So what it means is that for Ghana, every company from January to December, that is your financial year. So the law requires that 4 months after your financial year, you need to file an audited account. 4 months will be April, 30th of April, to file your financial return. If for some reason you can't file by that time, you write to the Commissioner General stating the reason why you cannot meet the 4 months deadline. Then you apply for an extension. The maximum extension you can get is 2 months or 60 days, which is up to 30th of June to file those returns. And for that, you can apply under Section 30 of the Revenue Administrative Act 915. It talks about extension to file tax returns. So based on that act, you can apply for extension if for some reason, maybe one of the directors or the responsible individual to prepare the accounts is not available in the country. You can file for an extension to prepare those accounts. Thank you. So I think we've talked about the financial account. So we move to managerial accounting. Managerial accounting, as the name implies, is mainly for management decision. So here we talk about managerial accounting uses much of the same data as financial accounting, but it organizes and utilizes information in different ways. Namely, in managerial accounting, an accountant generates monthly or quarterly reports that a business management team can use to make decisions about how the business operates. Managerial accounting also encompasses many other facets of accounting, including budgeting, forecasting, and various financial analysis tools. Essentially, any information that may be useful to management falls underneath this umbrella. So management accounting is just preparing an account mainly for management to make informed decisions. That is why we do it monthly, quarterly, so that, let's say, beginning of the year, you can do a budget. Then from that, you can prepare every month, you can look at the variance, you can look at the actuals, do a budgeted against the actuals. And then if there's any variance, management can take decision. If some expenses are going up, they can look at taking measures to help reduce those expenses to make the company more profitable. That is basically what managerial accounting focuses on. It focuses on management using the account for decision making. That is management accounting, managerial accounting. Then we have the third one, cost accounting. Cost accounting, just as managerial accounting, help businesses make decisions about management, but cost accounting mostly deals with costs. It looks at accounting for per unit cost in production. Mostly it's used in production. Cost accounting considers all the costs related to producing a product. Analysts, managers, business owners, and accountants use this information to determine what their products should cost. In cost accounting, money is cast as an economic factor in production, whereas in financial accounting, money is considered to be a measure of a company's economic performance. That is basically cost accounting, used mostly in the production sector. Then look at what? The importance of what? Accounting to the investor. We've told that what accounts are used for different purposes. One main purpose is what a regulatory requirement, prepare accounts to satisfy the regulator, to satisfy the shareholder. Shareholders are investors into your business. So they also need the accounts to make informed decisions, to see whether they will get returns on what? Their investment. So they say what the work performed by accountant is at the heart of modern financial markets. Without accounting, investors will be unable to rely on timely or accurate financial information, and company executives will lack the transparency needed to manage risks or plan projects. So what you need to understand is that the responsibility of the accounts is with management. Management prepares the accounts and then they present it to the shareholders at the end of the year at an AGM. They present the account. So how would the shareholders know that the business is doing well? It's through their accounts. When an audited report is presented to them, they can know whether the business is doing well, and based on that, they can know how much to declare as dividend and how much to retain in the business to run it going forward. That is basically what an investor needs the accounts for, to know whether it's very profitable to invest in your business or not. That is the main. So if there's no financial statement, it's difficult. He cannot even know how your money, how your cash flow comes in, how you expend it, and how things can be done to improve it. But once there's a financial report, he can know how things are being done and how to invest, where to invest. So that's about the accounts, the importance of accounting to the investor. Then we look at what? The books of account to be kept by an MSME. So we talk about the channels. These days, you have a lot of digital channels. We have the cloud. You can keep your information on cloud. You have QuickBooks. We have accounting softwares like QuickBooks, Tally, Sage, Xerox. They all help to prepare financial statements. So once you key in the data, this software helps you to prepare your financial statements on the go. If it's for a small business, but when it's big, you might need an accountant also to help put in this data and maintain this information. Then we have on-site books. These are for the basic sales day books, the purchases day book, the petty cash book, the petty cash reconciliation reconciliation, you have the payment vouchers, vehicle record keeping, advice for payment, bank reconciliation, asset list, financial policy, receipts, creditors and debtors book, invoice, expenditure, and purchase book, and tender evaluation form. Those are books that you can keep. You don't need to keep all. It depends on the nature of your business. That will determine the kind of books that you should keep. It depends on them. So these are some. So it's not that by force that you have to keep all these books on site. No, it depends. If your vehicle, your company, for example, you don't have a vehicle, you don't need a vehicle record keeping book. So you look at what your nature of business, then you look at the books which suits your business, then you keep them on site. And that is about the books of accounts. We can go to the next slide. So we look at our tax, accounting, audit, and compliance laws to be aware of. The first thing you need to be aware of for every company, you need to be aware of what? The Companies Act 2019, Act 992. That is a law every company you need to be aware of. And that is the heart of every business. So you look at the Companies Act, that is the mother law that you need to be aware of. Then you also need to be aware of what? The Income Tax Act 2015, Act 896. There's also a very key law you need to be aware of. Then you also need to be aware of the Revenue Administration Act 2016, Act 915. Then also, depending on your nature of business, if you are supposed to be registered for VAT, you need to also be aware of the VAT Act 2013, Act 870. And also, what I'll say is that you need to be aware of the Banks and Specialized Deposit Taking Institution Act. You need to be aware, but those ones are industry specific. We have so many acts, but what I mentioned is the basic. But there are other. We have the MPRA Act. We have so many acts, but it depends on your business. So you need to be. Those are industry specific laws that you need to be aware of. So you need to know that one is just your industry. So, but the basic ones because first of all, before you have to register as a company, you go to the registrar general, get all your documentation. Everything you do must be in line with the Companies Act. Then every business you are supposed to pay tax. That is why you need to know the Income Tax 896, and then also the Revenue Administrative Act 2016, Act 915. That's about the laws. The laws you need to be aware of, and then the basic other industry specific laws. So books, every business owner must read on accounting, audit, and taxation. There are so many books, but one of the books you need to read for a small business, the business owner. One book I would recommend is a book by Ali Nachia, The Tax Laws. It's about tax laws. Then for another one by Dominic. Now, what we'll do is that we'll share those lists with you so that you can look for them and then you can read them as a business owner, just to know basic taxes, basic accounts, and then just to have a fair idea as a business owner to know what you are doing. So that when you employ an accountant, you need to know certain things. If the accountant is doing right or wrong, you should be able to tell because you've read some of these. We'll share all of them with you. Then the next one is processes, accounting and audit. Prior to registering a company, what do you do? To register a company, you come up with a name. Then you do a search at the Registrar General's department to check whether that name is available or not. If the name is available, these days everything is digital, so you can download the registration forms online. But the key things you need is a minimum of 2 directors, a secretary, and then an auditor. Those are the main things you need to register a business. okay, to register a business. Now, what it is that after registering, there's something we call beneficiary owners. Those are the shareholders. So the beneficiary owners help you to know who the shareholders are and whether they are politically exposed persons or not. All those things are key in registering a business. And then you also, before you check the director must not be a director of a company which has gone insolvent or not. So he will not qualify to be a director. When you look at the Companies Act, which I believe has been spoken extensively yesterday, it talks about who qualifies to be a director, a secretary, and an auditor. All those things were dealt with. I'll not go. Then from there, you move on to what? After getting your registration from the Registrar General, you move to the Ghana Revenue Authority. That is where most people have a problem. After registering their business with the Registrar General, they just leave it without going to GRA to regularize their activities. Then you do that. They've been operating for so long, yet they don't know much about taxes. They've not filed their returns, they've not filed their taxes, nothing. So what you need to do is that you from Registrar General's department, you move straight to the Ghana Revenue Authority. Then you register your company for taxes. They will have an interview with you. You need the CV of the directors as well, and they'll give you a form you fill. Then they'll have an interview with you. Based on that, they will know the type of taxes you qualify to be registered for. Then based on that, they'll give you what you know as a provisional assessment. The provisional assessment does not mean you've made those taxes, those profit to pay. What it just means is that they are assessing you based on estimates. So, and you pay it in quarters. You pay it in installments of 4 quarters. So every quarter you pay a quarter of the provisional assessment. So let's say if they assess you for 2,000 cedis as your provisional assessment for, let's say, 2022, what you do is that by the end of first quarter, which will end in March, you should pay 500. The second quarter, which will end in June, you pay the other 500. The third quarter, which will end in September, you pay 1,000, the other 500, which makes it 1,005. And then the last quarter, which will end in December, by that time you should pay the other 500, which makes it 2,000. So this is what it is. If at the end of the year, you submit your financial statement to the GRA, and let's say that your tax liability is supposed to be 2,500 for the year 2022. Because you've already paid 2,000, you only pay what? The top up of what? 500 for your taxes. And that is, so that 2,000 you've paid is not lost. What also happens is that if you present your financial statements and your taxes is supposed to be 1,005 and you've paid 2,000 to the general, what it means is that that 500 in excess will be carried forward to the subsequent years to offset your tax liabilities. That is how it's done. So that I hear people say we've not started business and we are paying taxes, which is true. But once you pay those taxes, you don't lose that money. It's on account for the government. It's on account. You don't lose those money. It goes to offset future tax liabilities. That is how the tax payment work, the provisional tax assessment works. Then the next one is what? After you look at our internal control. So this looks at our internal controls, periodic assessment, quarterly or annual renewals. So what it is, this is more of management accounting. So it looks at when you prepare at the beginning of the year, you prepare your budget. Then during the year, you prepare the actual report. So you look at the variance. Then based on that, you take in measures internally to help reduce or mitigate the risks of any tax exposure, or look at anything that is causing an increase in expense, which is non-proportionate. You look at it and then you deal with it. And then the renewals. What is this? Is that when you register a business at Registrar General, that is not the end. The law says that after registration, you have about 18 months, after which you come and then you file your annual renewal. Then from 18 months, you have 12 months periodically to file your annual renewal. Most people fail to do this. After registering their business, they just leave it there and say, oh, but I've not done anything. I've not done anything. So why should I go and renew? The key is that Registrar General is the one that keeps records on every company. So what it is that everything you do as a company, you need to inform them. If you've not worked, you file your annual renewal and you tell them that it's a form you can download online from the Registrar General's website. You download it, you fill the form. If you've not worked, you tell them that you've not worked. So based on that, you can't add accounts. Or you prepare a statement of affairs to add to it, to show to them that you've not done any work. But most people, because they've not worked, they don't prepare any account. But once you don't work, you do what we call statement of affairs. And that will go to prove that, yes, indeed, your company has not worked. So that is what you need to know, that every year after registering, you have 18 months to file your annual renewal with Registrar General. And from there, you have 12 months, every 12 months to file at the Registrar General. Then these are good documents to keep. That's like variance report and all that. So variance report looks at a report of budgeted against actuals. When then you come out with the variance. Then based on that, once there is anything in the variance report which you don't agree with or which is causing financial loss, you need to deal with it. And based on that, when you master to deal with it, that will help your company to grow as a whole. That is what it looks. That is what we mean by good documents to keep. And things worth noting. These are more graduated tax, PAYE, determining. So these are things you need to know as a business owner. The graduated tax, PAYE. These days, what it is that the PAYE, we have a software online. So once you go on Google, you type the 2022 PAYE schedule, you follow the link, it will take you to the general. You can go to the general website. You can compute the salaries by the app. You don't need to work. The days of manual calculations are all gone. You can just do this thing using the app, and then you can solve the salary, do the salary, compute the salary and everything. Then VAT analysis and computation, payment of service tax, then withholding. So for the VAT analysis, it talks about more of invoicing, how to raise invoice. I think we'll talk about it in subsequent slides. So let me talk about the payment of service tax and withholding. Withholding, when you look at section 116 of the Income Tax Act 2015 at 896, it talks about the types of transactions and the rate at which you withhold. There's a schedule that talks about all the taxes and the rate to withhold. So if, for example, you're a retailer, you deal in goods, when somebody is paying your company, he's mandated by law. When another company is paying your company, it's mandated by law to withhold 3% because you are dealing in goods. If it's works, the rate is what? 5%. And if it's a service, you engage the service of, let's say, a lawyer, an accountant, an architect, a professional, it's 7.5. So those are the rates, and it goes on and on. If you rent out a space for residential purpose, the rate of withholding tax is 8%. When you rent out a space for office use, the rate of withholding tax is 15%. Then it depends. If it's those for rent, it's a final tax, but for the professional fee service charge, this is how it works. Once you withhold on, let's say, the service of an accountant or a lawyer, what it needs is that if, let's say, the accountant gives you an invoice of, let's say, 10,000, then what it means is that based on this, you are supposed to pay the accountant less 7.5. So you pay him about 9,250. Then the 750 does not mean you will keep it. What it just means is that you will go and pay to GRA. Then you will have a receipt which you will keep on your file. So that when the GRA comes for an audit, then they want to ask that why didn't you let these payments suffer withholding tax? You have the receipt to show that, yes, indeed, this payment you've withheld at the right rate. Then the person who you paid on his behalf, you give him what you know that a tax credit certificate. So he will in turn use that tax credit certificate to offset his tax liabilities when he's filing his returns at the end of the year. That is how the withholding tax system works in Ghana. Thank you. Yeah, so like I said, we are coming to deal with the issuing of VAT invoices. This is an exercise. I want us all to look at it. So we have what we call VAT exclusive invoices. Then we have VAT inclusive invoices. So I've put some scenarios across that we can all look at it. They say, well, assuming you are a retailer, you issue a VAT invoice for a customer who buys goods worth 10,000 cedis. So this is the case. Issue a VAT invoice for a customer who buys goods worth 10,000. So what it means is that the VAT, your VAT is on your invoice. So now, because you're a retailer, the VAT rate for retail is 3%. Then we have COVID-19 levy, which is what? 1%. So in all, it is what? 4%. So what you need to understand is that what comes, the invoice total, anytime what comes to you is 100%. What comes to the business owner is 100% in this case. And the law is saying add 4% on what comes to you and bill the client. So in such a scenario, what we need to do is that if you want to find the VAT element, it will be 10,000. That will be your cost, your goods worth 10,000. Then 1% COVID, that is what? 100 cedis. Then 3% of what? 10,000. That is what? 300 cedis. So what it will mean is that your VAT invoice will be 10,400. At the end of the day, the client will pay you 10,400, but your income is only 10,000. The 400, you will receive it, issue the customer or the client a VAT invoice, and then from there, at the end of the month, you go and file that 400 cedis as your VAT return for the month with the GRA. So if you have, let's say, 10 or depending 10 transactions, you lump all together, then you file, you raise 10 different invoices, but at the end of the month, you only file one return. So if I saw 10,000 today, 5,000 tomorrow, 3,000 tomorrow, the day after, when at the end of the month, I sum all of them together. So let's say if my total sales for the month is 50,000, I'll just file one return, which will be what? 50,000. And then I pay the VAT once. That is how I do it. I don't pay different VATs for the month. You just file all, then you pay one VAT for the month. That is how it is done with this VAT. You lump all your invoices for the month together, then you file. So this is how it is done. If we are in January, the law gives you 1 month to file your January returns. So what it means is that invoices you raise from 1st January to 31st January, you have to file them by 28th of February, by the last working day of the following month. So in this case, it will be February, the last working day in February. You file the VAT return for all the invoices you've raised in January. That is when it is due for filing. You don't keep it excessively. No, you have 1 month, 30 days after issuing the invoice to file the return. That is how it is done. Then the second one says, well, assuming the 10,000 is VAT inclusive, kindly issue an invoice which will show the breakdown of VAT and your net amount. So what I told you is that what the amount that comes to you is 100. The amount that goes to government in such a situation, we are dealing with the first one, is 1% COVID and 3% VAT. So what goes to government is 4. So if I want what comes to me, it will be 100 over what? 104 times the 10,000. Because why? This 10,000 includes government. So I just want to separate what comes to me and what comes to government. It is 100. 100 comes to me. And then the whole invoice is 104. So that's how come it's 100 plus 104. That's the base times 10,000. That is how you do it to get your net amount. 100 over 104 times 10,000. Then when you do it properly, one second, I'm taking it through. One second. You will get 9615. That is what comes to you, and then the difference go to government. So using that is for retailers. And there's the other one we call service business. Service business, that is a bit complicated. I would have loved to. I'll show you the workings. I will send it to you because that one, this is how it's done. 100 comes to you. Then we have 2.5. You out of the 100, you add 2.5 NHIL, another 2.5 get fund, then 1% COVID-19. So what you do is that it will be 100 plus 2.5 plus 2.5 plus 1. That will give you what? 106. When you get a 106, then based on that, you add the VAT of what? 12.5 to it. 106. You add the VAT of 12.5 to the 106. One second. VAT of 12.5 to it. That's how it's done. So we'll show you the workings as we go. I think for time, we'll show you the working. Yes. And we'll let you have it. Let's move on to that. Then the next thing is what? Audit. This is an audit is an independent examination of financial statements of an entity that enables an auditor to express an opinion whether the financial statements are prepared in all material respects in accordance with an identified and acceptable financial reporting framework as international or local accounting standards and national legislation. The view of audit is presented by ISA 200, Objective and General Principle governing an audit of financial statements. I will not dwell much on the audit because of time. We have different types of audit. We have compliance audit, forensic audit, tax audit, system-based audit, risk-based audit, operational audit, and financial audit. So I'll just take some in subsequent slides, then we'll look at them, we'll discuss them in details. So financial audit. The purpose of financial is to make sure financial statements compile generally accepted accounting principles, standards, conduct audits in accordance to generally acceptable auditing standards, integrated or specifically designed for public companies. That's different. Then we have what? Compliance audit. Compliance audit, the main purpose is to make sure an entity that receives financial assistance complies with laws, regulations, and agreements and standards, conduct audit in accordance with generally acceptable government auditing standards. Then operational audit. The main purpose is to evaluate the efficiency, effectiveness, and economy of an entity's operation. Standards. conduct audits in accordance with to professional practice of internal audits. So basically, these are some of the types of audit and what they are, what they mean. Then importance of audit. So audit determines the what adequacy of what internal controls. They promote best practices for controls. They ensure compliance with policies and regulations. They identify operational inefficiencies and waste. They review IT projects, systems, and technology. They provide objective insights. They assess efficient and responsible use of what resources. That's the importance of audits. They ensure compliance with policies and regulations, provide objective oversight, assess efficient and responsible use of resources. That is why some of the reasons why we need an audit. How can audit help an MSME grow? By identifying existing or potential weaknesses. Through an audit, it gives the small business owner the opportunity to work on such inefficiencies and improve the overall running of the business. An audit can also provide the small business owner with details of expected profit margins and how they can be achieved. You have so many types of audit procedures. One is what inspection of records and tangible assets, observation, inquiry, confirmation. So recalculation, reperformance, analytical procedure. So, like I said, you do an accounts. Then once the auditor comes, he needs to confirm or check certain things. So let's say in your financial statement, you said you've made sales of this much. He needs to confirm by maybe checking your invoices. He also said you have what? A debtors balance. You have debtors balance of this much. Debtors are people who owe your organization. What the auditor can do is that he can call those people and find out from them if indeed they owe your company this much. That is what you mean by confirmation. Then real performance. You can look at some of the things he has done and redo them again to see whether indeed you get the same results. Then if, let's say, the financial statement says they have a land in the building, you can go and verify the asset for yourself to see if indeed it really exists and it's in the name of what? The organization. That's about the inspection. Those are some of the procedures to perform during an audit. Then, aside the performance, the process, you need what we know now what? Audit evidence. So some are there. So you gather them by doing the physical examination, the confirmation, documentation, which is really, really key. Like we spoke about it from the beginning, that documentation is everything. The tax law has really emphasized on this. When you look at Section 27 of the Income Tax Revenue Administrative Act 915, it talks about documentation. The Companies Act have structured it in Section 127, which means that every business owner, to be on top of the game, you need to have your documentation right. If you don't get your documentation right, trust me, you have so many problems in your businesses. So that is why, as an auditor, when we come, there's a saying that what, in God we trust, all other men bring evidence. So evidence is the name of the game. As auditors, they don't believe anything you say till you provide evidence to prove it. That is even why when you look at the tax law, there's what we call burden of proof. The burden of proof is under Section 92 of the Revenue Administrative Act. It talks about what you have to prove it. How do you prove things? You prove it based on documentation and evidence. That is also they've done it such that everything you have to prove it to back your claim. And that is we as auditors we come to do. We just check that what you said, is it really the case as what is on the ground? If it's what we see on the ground is exactly what you said, then we say that your financial statement is free and fair. It's a clean report. Everything, what you said is as it is, and that will make investors what believe in the audit in your accounts, because you don't doctor any figure. You don't what it is what you reported, and that is about it. Then we have a recalculation, re-performance, observation. Observation is they coming around to see you monitor a process that you undertake, just to see whether clearly what you say is the standard operating procedure is what is being done. That is about observation. And the next slide. Then I have samples, audit report samples, statement of profit or loss samples, notes, statement of cash flow, notes to the financial and management letter. This is a sample of a statement of financial report as at 31st December 2019. So this is for XXXX Limited. That's a dummy company. Then we have what? Asset. We have non-current asset, property, plant, and equipment. So when you go to, there's something we put there, that's the note 3. So the note 3 will tell you the breakdown of how that figure came about. And you see that if it's just land and building, it's motor vehicle, it will show you the type of assets that the company have in their records. That should give you them 9 million. That is about it. And then the current asset, we have trade and other receivables. So if it's a trading company and people they are expecting funds from, that note will tell you who and who owes you what and how much. And then we have cash and cash equivalent. Those are cash and then short-term investment. They are all cash equivalent because they can be turned into cash within the shortest possible time. And the next thing is taxation. If it's on the asset side, it means that this is a tax asset to you. It means that you've paid. So somebody like, let's say, has a credit balance with the GRA. If it's on the liability side, what it means that he owes GRA the tax to that team. That is what it means. And all these things will be found in the notes. But what it is that the Companies Act requires or mandates us that we put 2 years comparative figures there. It's a requirement that you show 2018 and 2019. It also helps investors to know the trend, to see just by looking at your report, to see whether you've done well this year compared to the previous year. That is about it. But for the other samples, we'll share it on our website. We share the other samples on our website. Thank you all for your time and attention. If you have any questions, thank you. Okay. Okay. So show me this one. This is the question. That's so. Question Lawrence is asking: do one has to start the business before informing the GRA for the said taxation? What it is that you have to register your business first. Once you register, the best thing is that you go to GRA and tell them what you are doing, so that they know and they have an idea of where you are. Because if you are starting your business, how are you starting it? If you have to raise invoices and you have to raise VAT invoices, how would you raise it if you've not informed the GRA? So what it means is that the ideal thing is that from Registrar General, you move to the GRA to inform them about your business. Then they also guide you, and then you know how to be compliant in terms of taxes. That is it. Ruby Mills is asking, is there a computerized system where if amounts are imputed, a company can receive the VAT to be paid, the amounts to be paid to VAT, or an accountant has to be present to do all these calculations? Okay, so we have systems and software that can do all these calculations. Like I said, we have QuickBooks, we have Tally, we have Sage, and all those things. So you can use those ones. If your business is not that big, you can just use the accounting softwares to do all those calculations. And even these days, there are apps and softwares that you can use it. So you don't need to have an accountant on the field if it's a small business. What I rather advise is that invest in the softwares. because as a business owner, it's also good for you to know some of these basic accounting. So you need to know this software, how to use it, and know accounting, basic accounting. If the business goes to a point, that is when I think you need to get an accountant. But when it's a small business, you just need to invest in the software like QuickBooks, Tally, and you can do it yourself. These days, softwares are even giving you statement of financial position, statement of profit and loss. It does everything for you. It does everything. So you don't really need an accountant. It is when the transactions go beyond the point, that is when you need an accountant. In these ways, people are working smart, not hard. So you need to just invest in these apps. That is the way we are going now. So you don't need people on site. You can go to a business organization with just 2 people and they are making millions because what they have invested in software. That is what you need to go. Thank you. And let me see. So Eto/says, what if you make losses in a particular year? Do you still pay taxes? The general is that you pay taxes based on profits. So if you make losses, you don't pay tax. You don't pay tax if you make loss. Taxes are based on profit. The general tax rate for companies is 25%. And then we have industry specific tax rate, but the tax rate is 20. So you don't pay. What it is that if you've paid, that's why I say if you've paid provisional assessment, provisional tax at the beginning of the year, that money will not be lost. So if let's say you've already paid 2,000 to January for a particular year, but you don't make profit, that 2,000 will be a credit for you in the subsequent years. It is not a loss. It is never a loss. So you don't pay tax if you don't make profit. There's no way you pay tax if you don't make profit. Okay, so Citizen Kofi Pencil says, I wish I could give you a standing ovation. Yeah, really. Thank you, Kofi. Thank you very much for that. Thank you. Keep it there. Okay, so John Corbiner, please don't forget to send us the recommended books. Okay, so I'll send it to you, John. I'll send it to you. There's not another question. Bismarck, Bismarck. Brady says, if you have a business idea where your money cannot purchase the needed machines, what do you do? So one thing you can do is that it depends on the money you want. But what I can say, you can form partnerships. You don't need to be a lone ranger. You can have strategic partners that you can share the idea with. And I know people will buy. One key place you can start with is your family. You can start with your brothers, your siblings, because they will believe in you. Then what I always tell people is that start gradually. You crawl before you walk. So you don't need to start $1 million company overnight. We start gradually. So if, let's say, let me think, if you are buying, you want to start, you have a business idea, you can start small from the corner and the little you have. And then with time, you can turn it into a big business idea. There, big people we see, they didn't just come overnight. It took time and years of practice to get to where they are. So it takes time. So that is what I'll say. If you don't have money, just take time and discuss it. Form partnership. That will help. Eto/Slash says, what if I can't show documents for a certain transaction, such as taking a taxi? What would I do? That's a very good question. So what it is that, what I'll say is that you need to keep as much records as possible. Documentation is key. So there are some, as humans, the GRE will understand that. So what you, in such a situation, what you know, you keep something called petty cash voucher. So when you pick a taxi, let's say the taxi is 25 cedis, you need to have documents in-house to show that indeed you spend 25 cedis. Though you cannot get receipt, you should have like a petty cash voucher, which will deal with a certificate of honor, which will deal with some of these petty transactions. Because I know that there's no taxi driver who gives receipt. Maybe Ubers and then they give receipt, but you have certificate of honor, petty casual, and all those things. You can keep them in your office. It's not everything, because if you go and buy water, drinking water, sometimes you don't even get receipt from a corner store. You don't get receipt. But what you can do is that you keep petty cash voucher or certificate of honor in your office, so that when there's an audit, we can use it as a source document to make a point. And that is what I'll say. Yes. Issa Adele says, is there a way one can speak to you? Yes, there is a way. You can contact us at J Venture Capital on what? 0302 975 907. Let me go over again. 0302 975 907. You can contact us at J Venture Capital, or you can send us an email at info@jventurecapital.com, and you can speak to me. It says, inside this is, how would one receive a list of softwares and the recommended so the softwares and the recommended books, we'll share it on the website, on the portal, or send us an email and then we'll respond to you for those information. Daniel Makion Dabu says, please, can I register my business online, or I have to go to the office because of where the business is located? That is why I'm asking. Okay, so what it is that you can download the forms online and then you can register online. But I would advise that you download the forms and then you fill it. You get one thing you need very key is an auditor's consent letter. You need, because I've mentioned that to start a company, you need minimum of 2 directors and a secretary and an auditor. And there is a qualification for the auditors, the company directors, the law specifies, but the basic one is that they must not be a director of a company which has been liquidated or has gone into bankruptcy. So what I would suggest is that get the forms online, get the directors, the secretary, the auditors, and then the shareholder. You need to fill what we know as beneficiary ownership form. We need to know whether the shareholder is a politically exposed person or not. Get that form and then fill it. When you fill all of them, I think you can just take a day or two and then you go to the registrar general. They can deal with it for you. Or if you're having challenge, you can contact us at J Venture Capital on 0302 975 907, or send us an email at info@jventurecapital.com, and we can help you resolve your business, help you register it as soon as possible. Yeah. Is there any question again? Now do it says, that's my sister. Please, I wanted to start a business, but AMA came to my premises and started asking questions about taxes. Why is AMA involved in tax collection? That's a good question. AMA is a wing of what? The local authorities. And then the GRA is for government. So AMA, they are asking about local, it depends on the nature of your business. By AMA, they are asking, they will be more interested in the local taxes, the business operating permits, and all those kind of things. That has to do with AMA. And it's not, it depends on your locality. Most people mistake it that once that, but we have divisions from where our office is. We are Chado. So we mostly are handled by LADMA. If you are around Adabraka and all those places, AMA. And we have what? Like different Katamanso municipal assembly. So it depends on where you are. And but AMA will not be interested in your taxes. They are interested in your local business operating permit. That is what AMA is interested in. Yes. Thank you all for your time. Thank you. So tomorrow we'll have another session on branding with our branding guru Bernard Calvin Clive. Same time at 11 a.m. See you all tomorrow. Thank you. So I try my best.